Hello learner, welcome to Manifested e-learning platform. My name is F.A. Emlyn Ngwiri, a practitioner within the financial services industry in Kenya. Today we are going to learn about asset allocation. The focus will be on strategic and tactical asset allocation. To narrow it down further, we are going to learn about implementing choices and trying to identify the issues that portfolio managers face when managing a portfolio, either strategically or tactically there. To put it into perspective, because we are learning about asset allocation, trying to allocate funds to specific asset classes. Asset classes could be bonds, stocks, cash, derivatives, alternative investments, and so forth. We need to understand how we are going to apply implementation strategies onto strategic asset allocation, implementing strategies to tactical asset allocation. What is this strategic and tactical asset allocation? In brief, strategic asset allocation can best be explained as follows. You try and formulate the portfolio over here, not trying, saying that you formulate the portfolio right over there. This formulation requires 3 steps. Portfolio management process. Number 1, planning step, where you try and identify options or asset classes that you intend to invest in. Number 2, execution step. Planning step, execution step. Under execution step, what happens is that now you actually invest in the asset classes which have been identified as to meet the objectives of the portfolio, and which are actually constructed under the planning step there. So execution is where you actively engage or actively invest in those asset classes, stocks, bonds, and maybe cash or alternatives. The third and final step, portfolio management process, is feedback. Feedback right over there, or what we can say, monitoring and rebalancing. And rebalancing. Put a small arrow there, rebalancing. This is, of course, a very key topic under advanced portfolio, and we are going to learn more or very incisive details about how we can be able to monitor and rebalance the portfolio. But for now, this is what we say the portfolio management process. Under the planning step, what is needed is that we need to identify either the strategic asset allocation or tactical asset allocation. So we try and formulate the objectives against constraints there. The objectives of a portfolio are risk and return. So here is risk right over there. I can make it much more clearer. Risk, return, that and that there. The constraints include the liquidity, legal, time, taxes, and unique circumstances there. We had already identified the objectives and the constraints, and we expressively explained what they actually what they actually mean under different institutional investors. So the institutional investors in this case could be commercial banks, could be insurance companies, could be foundations, endowments, and so on and so forth. So please go back to that lesson or that lecture that we had actually covered the objectives and constraints for those institutional investors. So what I'm trying to explain now is this portfolio management process over here, in the context of strategic asset allocation, has a long-term view. So for strategic asset allocation, it has a long-term view. The feedback or the monitoring and rebalancing takes place after a very long period of time. Once you formulate the portfolio right over here, you go to the planning, execution, the feedback or the monitoring and rebalancing takes place after some time. Because the feedback takes place after some long period of time, we are saying that the markets tend to move or tend to undulate, so on and so forth like that. And proper analysis or proper allocation or proper rebalancing is actually needed to take place much more frequently. But you see, rebalancing requires, it comes at a cost. So monitoring and rebalancing needs to take place based on the investment committee's recommendations, maybe say every 6 months. And so if the market is very volatile, then it actually requires to be done much more frequently. So simply put, strategic asset allocation has a long-term view before considering monitoring and rebalancing. How about tactical asset allocation? Tactical asset allocation requires the analyst, or the portfolio manager, or the investment banker to have a series. Once you formulate the portfolio over here, you monitor and rebalance after a short period of time, monitor and rebalance, and so on and so forth, frequently. Like that. It comes at a cost, but you're saying because the market tends to undulate like so, the pest factors, pestel factors, political, economic, social, cultural, technological, ecological, and legal environment keep on changing. Right now, we're talking about blockchain. Blockchain technology is coming to really change the way the financial services industry is actually going to be formed. I'm actually informed that now when you go to some commercial banks in developed economies, you find that you don't even really need to have tellers right over there. So that's actually creating some form of disruption within the financial services industry there. Political tensions in Kenya, 2022, and we expect it to go through an electioneering cycle. So that is going to affect, say, the investment performance of some of the funds that portfolio managers actually invest in, like that, and so on and so forth. So because the market moves like so, constant monitoring and rebalancing is required, or frequent meetings with the investment committee to give them permission to actually either overweight and underweight in some sectors is actually allowed, like that, over the life of the portfolio, like so. Tactical has frequent monitoring and rebalancing stages. Strategic has got maybe fewer monitoring and rebalancing stages there. So now, to put now pen to paper, now that I've brought you up to speed, so if you allow me, I'll move on to the other side. But before I move on to the other side, we're saying that the portfolio management process requires a skill that is learnt over time. It involves the following steps. Of course, we have looked at this. I'm not going to really give the specifics about the steps involved, but we're just saying we need to explain the steps in portfolio management process so that we can drive the point home for explaining strategic and tactical allocation, implementing strategic and tactical asset allocation, and also the issues that actually present there. So planning, there. Once you form the planning, and I said planning requires the analyst, the investment banker, the portfolio manager to formulate the portfolio, trying to identify asset classes in which they're going to invest in. Once planning is done, and also requiring you to develop objectives and constraints, we move over to execution. Thereafter, this execution step involves the actual investment in asset classes that have been identified under the planning step. After execution, we move over to feedback, what we can be able to term it as monitoring and rebalancing. Monitoring and rebalancing. Once we have identified that, once we've explained the portfolio management process, the next step is now to try and link it with how we can be able to implement the implementing of choices with strategic and tactical asset allocation. So implementing choices. So we can say that the implementation of strategic choices or choices requires identification of the investment styles. identification of investment styles. Which styles are we talking about? Active, passive, and semi-active strategies over there. So we move over on this other side right here. The styles from down there, the styles include number one, you can say active management strategy, and we can say under active management strategy, a bit most preferably I can use a different color, just try and highlight. What happens under active management strategy? Under this strategy, the portfolio manager, manager actively invests in asset classes, actively invests in asset classes that try or that beat the returns of the index, that beat the returns of the index, returns of the index. This is the return that has been earned by the index. Supposing it generates NSE 20, say for example the year 2021, and a return of maybe say 18%. If that is the return that was earned, you should employ investment tactics or strategies that try to beat this. So you identify undervalued securities or undervalued equities in this example over here, so that you can be able to beat the index returns. So this is the return, supposing, for NSE 20, meaning that the 20 companies combined in a portfolio, equities, and a return of 18%. So you try and beat these NSE 20 securities, identifying undervalued securities or the ones that are going to generate for you positive alpha, the difference between expected return and required return. So supposing this is the return that your portfolio earns within the year, we say 22%. We are saying you have actively managed the portfolio by beating the returns as provided by index there. So for active management, you try and either invest in underweighting or try and invest in undervalued securities. You constantly buying and selling securities. Once you realize a return for this of maybe say a given amount of 10%, you sell that security. So you buy, for example, Kakuzi tea and coffee. You buy it within 3 months. Once you realize some element of return, maybe 10% return like that, you sell that security. You try and identify security that is undervalued also. Maybe you could go for another security such as EABL, like that. You earn a return of 10% like that. So you're constantly buying and selling, actively managing the portfolio so that you can be able to generate maximum returns for itself. So that is what you're saying is active management strategy. If we have active management strategy, then we have passive management strategy. So number 2, passive. Passive management strategy, passive. passive management strategy. Under the passive management strategy, let me just reiterate this. Under this strategy, the portfolio manager actively invests in asset classes that beat the returns of the index. If you're beating the returns of the index, then that means under passive management strategy, you're going to try and earn the returns similar to the index. So, you can say that under this strategy, the portfolio manager, portfolio manager actively or passively, in this case it is actively, passively invests and wishes to, can move over on this side, wishes to generate returns similar to the index, wishes to generate returns similar to the index, similar to the index. So it is investing in, say, ETFs, exchange traded funds, that is, or mutual funds that track returns of the index. So we are saying this strategy, so you don't even have to put it in brackets, tracks the index returns. This strategy tracks index returns. Index returns. We can also say, instead of using ETFs or mutual funds, we can also use cash positions, having a cash position and also investing in a long position in an index future, like that. Having a long position in an index future that is tracks the returns. We are going long on an index future, so we are buying a futures. So this is the index future. So we are going long. We are going to buy an index future that exposes our portfolio to returns which is similar to that index. So it's an index fund itself, a fund that is generated so that it can be able to invest in indices. So that means that if you invest in this, you will earn a return that is going to be similar to an index. So it is invested in, maybe say, in equities. It is also invested in bonds. For example, I'm just using this as an example. For bonds, but bond indices. Equity indices such as NSE 20 or the NASI, like that. And maybe it is also invested in maybe other asset classes such as MF, mutual funds, or maybe not necessarily mutual funds. We can say maybe we can be able to also say derivatives, like so. But we are only investing in derivative indices that are actually exposed to derivatives, bonds, and equities. That's what we're actually saying. So once we have learned about passive management strategy, saying that under this strategy, the portfolio manager passively invests and wishes to generate returns similar, so I should underline this, similar to the index. This strategy tracks index returns there. Once we have looked at that, we can now have the borderline between active management strategy and passive management strategy. The borderline is called semi-active or semi-active. Some individuals prefer to pronounce it as semi. Doesn't really matter. Semi. So number 3 is semi-active. Under this strategy, we are saying semi-active management strategy. Under this strategy, the portfolio manager permits underweighting, can underline that, underweighting or overweighting of securities and skill. At some points in time, you find that they are either inclined towards maybe investing in passive or passively. At other points in time, you find that they're actually inclined towards investing actively. That. So putting it in form of a visual representation, we can have it like so. So here being semi-active, active, here being active, and here being passive. The two extremes. Investing it practically is investing in an index fund or investing in proportions similar to the NSE 20, like I've just explained. Here, you may invest in either the NSE 20 using the equities section as a, or equities asset class as an example. You may either invest in the index return or in the NSE 20 returns, allocations. At some points, you may try and identify undervalued or overvalued securities. So under active management, you're trying to identify undervalued securities that you can be able to try and actually actively manage the portfolio by keep on buying and selling the securities there. That said, we need now to move on to look at strategic asset allocation issues. Now, what are the strategic asset allocation issues that actually exist? Strategic asset allocation issues may be looked at or may be assessed from the perception of the individual institutional investors, such as commercial banks, insurance companies, and so on and so forth. And so, of course, I'm going to be very brief because I was very specific when in one of the lessons that we've done under asset allocation, explaining each asset class, the objectives and constraints, the returns, the objectives and constraints basically. And so I'll be very brief about that because we're just looking at it from the perception, like I've mentioned, from strategic and tactical asset allocation there. So what are the issues? Allow me to move on this side. So the issues may be looked at from the perception of institutional investors. And we will start off by looking at commercial banks. Under commercial banks, be very brief, like I said. So banks. Commercial banks have got challenges in terms of liquidity requirements, because you're saying that the deposit that they actually receive from the customers or from the clients may be required at any given point in time. So how do they come up with that delicate balance of how much they should actually maintain within the bank vis-a-vis how much should they be able to actually lend? And that's where we come now and talk about the issues for commercial banks there. So the issues could be in form of liquidity issues, duration, managing duration. So liquidity issues, banks have issues or challenges in as far as, number one, liquidity, managing duration, or the amount of money that they should actually hold within the bank, or should they actually hold the money more? Should they actually lend the money more? Like that. In terms of liquidity issues, they're saying, should we actually consider maintaining or complying to CMA, rather Central Bank of Kenya's requirement for liquidity, those liquidity requirements. Number 3, we're actually talking about managing credit risk. Once you've actually lent the money out, how do you manage that credit risk? So managing credit risk. Credit risk is important, or these are concerns that actually affect commercial banks there. We can move on to another institutional investor. Second institutional investor is insurance companies. So I can label this as number 1. You will allow me. I can label this number 1. Number 1. This is number 2. You can see that this is insurance companies. And insurance companies, the issues, they have issues surrounding duration. How much money, how long are we going to be able to invest in specific asset classes? So number 1, we're talking about whether it's general insurance, or number 2, life assurance, or what we can call this is non-life assurance. Under general insurance, we're seeing that some of the issues that actually befall insurance companies include the issues about the risks of claims, or what we can term as claim risk. That is what is primary under general insurance business. As well, so we can also just rub over here and maybe multiply here, like mention liquidity. Liquidity is also a concern for general insurance companies. How much money should we invest in real estate? Because when the claims actually come, then we are saying that we need to actually manage our cash flows very well. Working capital needs to be top notch. And a life insurance business, and we're talking about managing duration. So managing duration risk. For how long will we invest in specific asset classes thereon? That's what we're talking about. So under insurance companies, general life assurance companies, please look at my lecture about about institutional investors. I actually expounded this further. So in the perspective of strategic asset allocation, we are saying that duration for commercial banks need to actually consider those issues over there: liquidity, managing duration, and also managing credit risk over there. For insurance companies, it's claim risk, liquidity risk. Managing duration risk is also a concern for insurance companies thereon. So other institutional investors, such as foundations. So number 3, you can say is foundations. Foundations. We're talking about the issues strategic asset allocation issues revolve around strategic asset allocation issues revolve around funding requirements, around like that. So I said this should be in different colors. Here, funding requirements. Liquidity liquidity risk, as well as other risks which may be maybe not credit necessarily, just maybe duration risk may also be an issue. Duration risk over here, and duration risk, and duration risk. How long are we going to invest in that foundation? And duration risk. So under foundation, you're saying strategic asset allocation issues revolve around funding requirements, liquidity risk, and duration risk thereon. As for endowments, endowments also have funding requirements as well as liquidity risk, but maybe not duration risk thereon. So number 4, endowments. The issues include, we can say, funding requirements, how much funds or how much money should actually be maintained within the portfolio, funding requirements, and liquidity risk, and liquidity risk are there. Other institutional investors, including maybe we can say microfinance institutions, also may have their own unique issues, but our central focus should be on these 4 right over there. Primarily strategic asset allocation. Now, under tactical asset allocation, the best way we can be able to understand the issues under tactical asset allocation is by looking at an example. So we need to note that tactical asset allocation involves short-term investment horizons, or tends to have short-term investment horizons. So you tend to find that movements away from strategic asset allocation towards tactical asset allocation is driven by the movements in the business cycle there. So we need to periodically review our investment portfolio, so that we can be able to attune or twist the portfolio towards realization of the objectives of our portfolio. Most of the tactical asset allocations are also based on assumptions. Now, the assumptions are driven by models. You can come up with financial models or models of the form like so. Y is equals to B0 plus B1x1 plus B2x2 plus B3x3. And we're saying that once these represent the x1, x2, and x3 represent independent variables. They're the ones that influence the y, or the element of returns over here. So these characteristics or these metrics right over here should be identified or should be used. These asset classes, so to speak, stocks, bonds, derivatives, and so on and so forth, should be selected in such a way that they should be able to maximize this output over here. And so we are saying that tactical asset allocation needs to consider that. This represents the intercept. When x is 0, what is the value of y over here? And we also need to add an error term right over here. So what is not included in the model over here, x1, x2, and x3, is explained by other items which are not included in the model right there. Tactical asset allocation practically is challenging, and so maybe most of these insurance companies, banks, and the rest actually implement strategic asset allocation. So the move is towards strategic asset allocation, but when the need arises or when the market is actually very erratic, then that's when tactical asset allocation comes into play. It comes, of course, at a cost, like I had mentioned before, and we need now to look at an example that can be able to explain how tactical asset allocation influences, or what are the issues under tactical asset allocation. So tactical asset allocation, we're looking at the issues themselves. So example reads as follows. William is a chief investment officer of an endowment that is invested 45% in US equities, 15% in non-US developed market equities, and 40% in US Treasury inflation index securities. They're usually called Treasury inflation protection securities. The endowment annually reviews its strategic asset allocation. Its IPS, or investment policy statement, authorizes tactical ranges of plus minus 10% in each asset class. Based on his own past observations and his reading of the investment literature, Davenport believes the following. Number one, US monthly equity returns are less sensitive to US business contractions than monthly equity returns of European markets, including Japan. That is, in US recessions, US equities returns may actually be relatively better than equity market returns in Europe and Japan. Number two, an increase in yield of one-year Treasury note indicates a decrease in probability of a recession in 1 year's time. Based on a decrease in the yields of US one-year Treasury notes, Davenport has suggested a 55-5-40 US equities / developed market equities / TIPS tactical asset allocation. Required, evaluate whether the recommended tactical asset allocation is feasible. Number two, appraise the logic of the recommendation. So we are saying that in trying to answer those two questions, we are being told to analyze whether William, being a chief investment officer, has tactical ranges that lie within the IPS. So the IPS is the foremost, or is the yardstick that we should be able to focus on when trying to develop tactical asset allocation ranges. So the IPS, we are seeing from the question, the IPS authorizes tactical ranges of plus minus 10%. So what does that mean? So you can come on this other side over here. So if we have plus minus 10%, and the initial asset allocation was 45%, 15% in non-US developed markets, and 40%. So we are saying we are going to move this plus minus 10%, this plus minus 10%. So of course, 10% of this is 4.5. So that means it's going to be this plus 10%. So plus 10% is going to go to 55. Sorry, not 4.5. So it's going to go to 55. So it can be able to go to maximum. The lower limit can be 35 to 55 for that asset class there. That's what I'm saying in terms of percentages there, plus minus 10%. Plus minus 10%, it can go down to 5% to 25%. Here, it can go to as low as 30% to 50%. So that is the area we are talking about. Now, the current asset allocation now is 55 over here, based on what William is actually stating. It's gone down to 5% for this other asset class and 40%. Yeah. As you can see, this is the previous asset allocation, 45% in US equities, 15% in non-developed market equities, and 40% in US Treasury inflation protected securities, so TIPS. So we are within the range as specified by the IPS, which is right over there. So we can be able to conclude in trying to answer part one over there that when we're told to evaluate whether the recommended tactical asset allocation is feasible, we can say that Williams' asset allocation, tactical asset allocation, is within the tactical ranges allowed by the endowment based on IPS. The second part of the question is asking us to appraise the logic of the recommendation. So we are saying it's based on the skill set that William actually thinks about. And we are saying that if William believes that those allocations are correct, then the decrease in the treasury notes like that should actually constitute towards generating a return that is going to maximize the portfolio return by extension. So we're also saying that William also expects that the US market is going to outperform. So he decides to increase the allocation from here to over here. Here is expected to remain the same like that. So the allocation over here was towards the US TIPS, Treasury Inflation Protected Securities. Here the allocation was towards non-developed markets. So non-US developed markets like that. And over here is, of course, we are saying is the US equities, US over here. So he believes that the market is going to outperform. It's based on the inner perception. So he increases the allocation from 45% to 55%. But on the other hand, he also believes that the allocation towards non-US markets and developed markets is going to underperform, and so he reduces the allocation from 15% to 5%. Treasury inflation protected securities is not going to be any change, and that's what we are saying, that shifting funds, of course, from US and from non-US to US equities seems to be logical, because that is based on his or her or his perception thereon. This brings us to the end of the lecture. This topic, asset allocation. We hope that you have enjoyed the topic, and I will leave you with an assignment as usual. So if you allow me, I can wrap this. So the assignment that I have for you is May 2017 5C. You can be able to look at that question in relation to tactical asset allocation. Tactical asset allocation, that is. Thank you for being with me for today's lecture. We hope you have enjoyed it, and thank you and God bless you.